Welcome back to the series of videos that explain how to complete the financial statement and analysis spreadsheet system. This video is the beginning of a series of videos on how to complete the income statement. This spreadsheet is part of the University of Wisconsin Division of Extension's Farm Management Pulse program. The full curriculum and spreadsheet itself can be found at the website addresses that are shown on the visual. My name is Kevin Bernhardt, and I'm both a farm management specialist for the University of Wisconsin's Division of Extension, and also I'm a professor at the University of Wisconsin-Platteville's School of Agriculture. Previous videos have discussed the completion of the balance sheet. The balance sheet can be thought of as the bookends to the fiscal year. So there's a beginning balance sheet, and then there's an ending balance sheet. Both of them show a financial position at that point in time. So you can think of it as January 1st, what's the financial position, and what's the financial position on December 1st. What happens in between? There's a lot of activities. We plant corn, we milk cows, we buy fertilizer, we pay for insurance, and all kinds of activities happen in between. And those activities are captured and recorded on the income statement. So it's the income statement that gets us from the beginning of the year to the end of the year. If we have good financial performance, which is what the income statement shows, then the ending balance sheet will be better than what the beginning balance sheet was. If we have poor financial performance during the year, shown by the income statement, then the ending balance sheet, unfortunately, will be worse than what the beginning balance sheet was. So the balance sheet, the financial statements are linked in this way. The balance sheets show financial position at a point in time. The income statement shows financial performance over the course of a period of time, typically 1 year. The income statement shows that financial performance. If the performance was good, we'll have a better ending balance sheet. So let's get started in our journey to complete the income statement. This visual shows the format of the income statement, and there are 4 major sections. Revenue from operations, which is the revenue that typically comes from normal operations. Sale of grain, sale of milk, sale of cattle, things like that. And of course, accrual adjustments, which we will talk about later. The second section is the operating expenses. These are the normal operational expenses that we would typically see in any given year. Feed, seed, labor, depreciation, insurance, utilities, vet cost, you name it. The fourth category is called other or non-operating farm income and expenses. These are income and expenses that are associated with the farm business, but they're not typical, at least they're not typical across all farms. They're kind of unique to each individual farm and each individual year. So that's why they're in this non-operating section. The 2 big ones that are here are interest expenses and gain loss from capital asset sales. Let's talk about those a little bit. Interest expenses certainly sound like they could be an operating expense, as we all tend to have loans, and that interest expense is part of it. But it's not common or typical across farms as in terms of being the same. So one farm may have very little interest expense because they financed everything without debt, where the next farm down the road may have a lot of debt in their financing and a lot of interest expenses. So it's not typical in that way. Also, too, it's an expense that goes back to the ability to be able to use somebody else's money. It's not operational per se. So the expense was used to buy, let's say, feed, seed, fertilizer, and so forth. The operating expense is the feed, seed, and fertilizer. The interest expense is the expense that you accrued because you use somebody else's money to buy those operating expenses. Gain loss from capital asset sales. If I have a $200,000 tractor that I originally purchased, and now through depreciation, it's down to say $100,000, and I sell that tractor. If I sell that tractor for $120,000, then I have a $20,000 gain. That's $20,000 more in my pocket compared to what I paid for that tractor and what I've depreciated out. So that is a gain. That's income, and that's referred to as a gain on a capital asset sale. However, I could have sold that tractor for $80,000, and in a way, that's sort of like having a purchase price that all of a sudden bumped itself up after the fact by $20,000. So that's a loss. That's actually money that I was not able to recover from the purchase of that tractor. And therefore that becomes a loss from capital asset sale. So those are in the non-operating section. They happen and they're farm related, but they're not typical for every year. They're not common every year, and they're certainly different in any given year across farms. So they're in that non-operating section. The final section is this non-farm income and expenses, and that includes primarily income taxes. Now, these 4 different sections lead to 3 different net income or net profit figures. The first is income from operations. And just as it sounds, that's the net profit that's being made from the operational part of the business only. So it's revenue from operations minus operating expenses. That gives us our income from operations. We like that number because it's comparable across farms. And it's a number that's often used in a lot of the financial ratios that we'll see later. The next net profit or net income figure is net farm income. And that's income from operations, but it also takes into account those non-operating farm income and expenses, primarily, again, interest that's being paid and the gain or loss from capital asset sales. That gets us to what our profit is for the farm itself, including both operating and non-operating income and expenses. The final net income figure is the one that's at the very bottom, and it is net income. And that's all the above plus or minus income taxes. Might have had a refund, who knows? So that gives us those 3 figures. All 3 of them are used in different ways. But one key to remember is this bottom figure, net income, is what is added to the owner equity on the ending balance sheet. And that's where that income statement and that balance sheet are linked. There's also 2 kinds of income statements. Cash income statement is the one that we often are familiar with. It's a record of cash revenues and expenses, but there are some key things that are either not included or are included that kind of break that rule. One of them is there is one non-cash item that's included on the cash income statement, and that's depreciation. There's also several cash transactions that are not included on the income statement. Principal payments, any principal payments made are not included on the cash income statement. Any down payment for a capital asset purchase is not included on the income statement. And any cash received from loan proceeds, that's cash coming into the business, but it does not go on the cash income statement. So there's a couple exceptions there for that. The second kind of income statement is the accrual income statement. The accrual income statement is a record of realized revenues and expenses. And what does realized mean? Realized is revenues and any associated expenses with those revenues are recognized in a year that the revenue product or service was made available and ready for sale. So for example, a quick example of this would be for crops. You harvest corn, you did all the work, you put the seed in, you did all the tillage, you did all the harvesting, you did all the work of producing a crop of corn that's available and ready for sale in year 2022, let's say. So that work was done in 2022, and on the accrual income statement, that corn revenue will be recognized in 2022. However, we might have stored it. And if we stored that corn and didn't sell it until 2023, it won't show up on the cash income statement until 2023. So that's where the 2 income statements can be different. So you might question, why do we have to have 2 of these statements? Well, the cash income statement is one that production agriculture is allowed to use for taxes. Most other businesses have to use accrual, so they primarily keep an accrual income statement. But production agriculture is allowed to use cash income statement for tax purposes. And we know that there's a lot of legal games that can be played with that cash income statement, prepaying expenses and various other kind of things to help manage our taxes. The trouble is that cash income statement then no longer really reflects reality, not only because of the games that are played for tax purposes, but also we have those things that are not included, like stored corn example that I just gave previously. So the cash income statement is great for tax purposes and tax management, but it is not necessarily very good for doing financial analysis or really understanding what the performance of the business is, or for making future decisions based on what the financials of the business are. For those things, we need the accrual income statement. The accrual income statement gives us the real situation, lets us know what the real performance was in reality. So that's what we need to get to. Here's an example of this. So here's a couple. They're at the end of the year, they had total cash revenue of $1.5 million. They had cash operating expenses costs, which include depreciation, of $1,525,000. So you take total cash revenues and you subtract off total cash operating costs, and you're left with a cash income from operations of negative $25,000. Now, if you're asked to look at that and say, not knowing anything else, and say, how's this couple doing? Your reaction may not be, well, they're not doing very good. They're losing money. They can't go on like this forever. However, that doesn't tell the whole story. Let's go to the next slide. What we didn't know from that previous slide is that they have $320,000 of grain in storage from this year's harvest that they haven't sold yet. That $320,000 didn't show up on the cash income statement because they haven't sold it yet. They also prepaid $90,000 of next year's crop needs. Well, that $90,000 is truly an expense for next year, even though we wrote the check this year. So that once we take that $320,000 plus that $90,000 and add it back into income, then this couple looks pretty good. So that's why we have to use accrual income statement if we're going to do financial analysis. Here's another example of that, of accrual revenue adjustments. Let's look at the first bullet point here. I paid $25,000 this year, year two. If you look down at the bottom, year two is the year we're concerned about. This is the year we're developing the income statement for, this area of red. So I did $25,000 of custom work that I completed and billed in year one. So I did the $25,000 worth of work in year one, but I didn't receive my check from my customer until year two. So on the cash income statement, that $25,000 is going to show up on year two. However, we know that in reality, it should be in year one. So we have to adjust that cash income statement to get to a truly accrual income statement by moving that $25,000. The second bullet point is very similar to the example I gave earlier. I have $100,000 worth of corn and soybeans in year two that was produced and made ready and available for sale in year two. And then I stored it in year two and didn't sell it until year three. By the same token, I had $50,000 worth of heifers that I did all the work of raising in year two, but I didn't sell them until year three. So the work was done, the financial performance was done in year two for both that $100,000 worth of corn and soybeans and the $50,000 worth of heifers. So I need to adjust my cash income statement, move those dollars back to where they belong. And in this case, that would be moving them back to year two in both cases. And now I would have, now when I do my adding and subtracting, I have a true accrual income statement. Well, same thing happens on the revenue side. Again, we're looking at year two here, and I used $20,000 of supplies in year two that I had purchased in year one. So this would be like prepaying expenses in year one. So it got to November, December of year one, and you had some taxes. You wanted to get that tax liability down a little bit. So you went out and bought some seed or fertilizer or whatever, $20,000 worth. That's a cash expense in year one, but you didn't use that seed and fertilizer until year two's crop. So in terms of financial performance of the true business, that $20,000 belongs with year two. And so we're going to move that over to where it belongs. By the same token, you get to the end of year 2 and you do the same thing. You pay $40,000 of inputs that are going to be used in year 3. So again, you have to make that adjustment, move that $40,000 over to the year that it truly belongs, and then you have your accrual income statement. So there's 2 methods for determining an accrual income statement. One of them is through a double entry accounting system. And the second one, which is the one we're going to use in the spreadsheets that we're discussing, is called an accrual adjusted income statement. And the way the accrual adjusted income statement is found is you start with the cash income statement. You can see that down here in the visual in the lower left-hand corner. You're going to make adjustments to that cash income statement by using the beginning and ending balance sheet. So that storage of the corn, for example, is going to show up in different ways on the beginning and ending balance sheet. We're going to use those 2 balance sheets together to make that adjustment, and that adjustment will be added or subtracted from the cash income statement to ultimately then end up with an accrual income statement. Looks a little complicated, but in the spreadsheet itself, once you've done your balance sheet, all those numbers are automatically transferred into those accrual adjustments, which I will show you later. So that's it in terms of the introduction to the income statement and what we have coming up. There are some challenges with the income statement that we'll have to discuss in the future videos. One of those is, where do we get the numbers from? How can we find those different numbers for expenses and revenues and so forth? A second challenge that we have, again, is depreciation. It always seems to come back to haunt us, and it does here as well. Breeding livestock has some peculiarities about it that we have to work with if you're a farm that has breeding livestock. How to determine the gain loss on capital asset sales. Where do we find that information to put on the income statement? That's something we're going to talk about. And hedging. Some of you may do some hedging as part of your price risk management. And if you do some of that kind of stuff, then that has some implications for the income statement as well. And so we'll take a little time to discuss that. Until then, thank you for listening.